Within my 15 years at the bank, one of the things I heard quite frequently was you can't have fraud without money laundering. Once a fraudster scams or gets money from somebody, the next thing that they do is typically use it. Unless a fraudster takes the money, buries it in their backyard, which is highly unlikely, they're going to do something with it. Now, the minute they do something with it, that then warrants a money laundering charge. Typically with those money laundering charges, not only does law enforcement have the ability to go in and take a look at where that money had gone to, but they also have the ability to use those money laundering charges to add additional years, fines, punishment to the person who stole the money or obtained the money fraudulently. It also allows the law enforcement or the prosecutor or the government to be able to take that money in any commingled funds with the fraudster's legitimate funds. So it's asset forfeiture, and therefore they can give restitution back to the victims or help pay for the cost of the investigation. So it's a pretty important tool from the law enforcement standpoint. But beyond just the layering of funds, beyond the money laundering charges, let's scratch at the fraud and AML aspect just a little bit. What we can really focus in on is the onboarding and expected behavior aspect of CDD. Can you take a look at people that are bad actors and stop them initially from coming into the institution through the onboarding process? Can you verify their identity? Can you look at the occupation that they have, the region that they live in, and come up with conclusions as to what the expected activity is for that individual? And then, based on the activity that's taking place in their accounts, make a determination as to whether or not this activity fits what is expected. So for example, if you have an individual, let's say they are a baker, you would expect to have normal activity associated with baking. Maybe it's purchase of raw materials like flour, sugar, or equipment to that matter. And then on top of it too, you would expect credits coming in from customers, probably low dollar, maybe an occasional high dollar that is associated to a catering or large purchase. But you certainly wouldn't be expecting massive amounts of transactions coming in from different areas of the world. You wouldn't be expecting those transactions to come internationally. You wouldn't be expecting hundreds of thousands of transactions for a small mom and pop type business. So if you take a look at fraud and AML in the intersection there, not only is there the ability to look at the suspicious movement of funds, the layering of funds after fraudulent activity, but also from a preventative standpoint of what is the expected behavior of these individuals that have been onboarded into your institution. So it's something you can take a look at and be able to utilize all the information they provided to you from an onboarding and then ongoing monitoring perspective of what to expect from that type of behavior.